Take me out to the ball game. Patrick, you can't sing that. You're Canadian. It's an American thing. All right, guys. Look, if you look at my profile, it says chart defined macroeconomics. So right before I show you these charts, man, everybody has a thesis. Everybody listens to the news, and CNBC has experts, and they're telling you what their thesis is on what is happening in the economics, right? There's the supply created inflation, printing money, and there's all these moving parts. And you're there, you're new, you're trying to figure out what are they talking about. Okay, and then you hear a news release on CPI, and then you see the price of certain assets you were monitoring go down, and then you say, oh, it has to have, that's the correlation. If that type of reading comes out, then that's what the price has to do. And then you do that a few times, and eventually you might decide to trade based on that news. And then CPI comes out, and the price goes in the opposite direction than the last time it happened. And then you're confused, and then you go back to the news, and you want to listen to these guys, their updates, etc. It's a mess, guys. That is a total mess. So you got to differentiate headline news, fundamental thesis, anything. All these little bits and pieces of information are a disaster. You cannot act or trade on that stuff because you don't have the whole picture, or you don't have enough elements to reduce or increase the probabilities of that possible move that you want to play working out. It's just, there's so many moving parts. And the more you do this, the more you realize that you keep hearing these people, and there's hundreds of analysts, thousands, each pushing a varying amount of capital behind them. It just doesn't make sense. You gotta admit that the market's way smarter than you, right? The aggregate of all these guys pushing their money will create the price charts. Whether you think there's manipulation, whether you think there's this piece of element, well, you knew something new today, a new piece of element, and knowing that you're able to learn something new, you have to accept that in the future there's some element that you didn't know right now that you will learn about going forward. So it's a dangerous trap to trade off that stuff, because then you're relying, or you think you have all the pieces of element. It's a false sense of security. So go to the charts. It's your simplest way to understand what's happening. So instead of me trying to figure out all the different economics, all the different models, and trying to apply that on the charts, force with bias my thesis on the price, all I have to do is look at the chart and then define the macroeconomics. The charts will tell me what the macroeconomic landscape is. For example, here is the SPX versus PPI chart. Here, I'll just open in a new image. And you'll see right away that, let me zoom out. I could just scroll like that, left, right. There you go. I know that when the SPX breaks down versus the producer price index, or an inflation for a proxy for inflation, I know that US equities go sideways for many, many years. They have a lot of more recessions. It's these green overlays. They have more chances of having more drawdowns. Here, it's a bull run for US equities, outperforming inflation, breaks down. What happens? Then in the whole 70s, reflates. You think you're a new bull market? No, rug pull, etc. You had the same thing in the 2000s, breakdown from a sleep mode line. And here's a blow off top in the dot-com bubble. Recession, you think you're out of the park? No, rug pull. And it's happening again. So instead of me trying to say, well, we're in a recession, or US equities can't go up, or they have to go down, just look at the chart. All the evidence you need from all the aggregate of market participants, what actually matters, right? It's not the thesis that matters, it's what the price does, because you want to play those trends. The only way you can make money is if you buy somewhere and the price keeps going up in your direction, and you want to go where you have the higher probabilities of that happening, right? Buying here and hoping the SPX outperforms inflation is a low probability play. The higher probability play right now is that the SPX just grinds sideways and has rug pulls along the way while it tries to rally up. All right, so let's go back here. I want to show you really these critical next two charts, guys. And it's not going to be a long one today, but you'll understand how with just two ratio charts of major asset classes You could define capital flows and know exactly where the odds are going forward. Okay, let's start with this one, guys. Okay, I'll go with the SPX because we did SPX versus PPI. Open this one in a new tab for your viewing pleasure. So here I have the SPX versus money supply. 1969. And here below I have the 10-year rate of change for that ratio chart. So as if SPX cannot outperform money supply, cannot get more of its share of the money supply. So whether there's more money supply, less money supply, expansion, contraction, money supply, it doesn't matter. If SPX cannot outperform those contractions and expansions in money supply, then it's not going to go good, guys. You'll see here it's underperforming M2. What happens? SPX has rallies up, goes down, goes up, goes down for 10 years, 15 years. You're not in a secular bull market where you have a beautiful trend to ride, where the dips are getting bought. You're not here. These are huge drawdowns, guys, right here. Here in the 2000s. Look at that orange line. Look at that, the 2000 huge drawdowns. Oh, coming back up, huge drawdown. Why? Because look, SPX versus money supply can't even do a new high. It's a lower low, lower high below this early breakdown line, which is now a wall. It's not able to get back above. US equities actually start nominally able to do new highs all the way down here, guys. After I could have drawn here early breakout line for SPX versus money supply. Once it breaks out above that, then it has the tailwinds. Then the dips are bought, and then you get a beautiful, look at that, minimal amount of drawdowns here as this thing rockets upward. All right. So that's step one, comparing two major asset classes, doing some basic TA, doing TA, guys. Okay, this is another thing. You see people putting charts out with no technical analysis behind them. It's a cloud of nothing, which could confuse anybody. You need clarity to be able to establish probabilities using a chart. You need to draw trend lines with objective, classical charting, rising trend lines with 3, 4, 5 touches. When these lines are broken, it's telling you that there's a momentum shift. So a highly occluded rising trend line like this, once it breaks down, it has a chance. It still has upwards momentum. But then the less and less steep these angles of these trend lines are broken, that's telling you that there's a slow down in momentum. And once you have flat momentum or neutral momentum, then you're much more vulnerable to having acceleration downwards momentum than the upwards one that you had at the beginning. So here's the 10-year rate of change, guys. For that ratio chart of between two major asset classes, defining those capital flows. And this is why it's important. While the SPX might go sideways, we'll know that when the 10-year rate of change is going down, we know that all this period here, and I'll show you the other chart to prove that. Right after this one, I'll show you the other one that proves that this is a bull era for gold and silver and oil. When the rate of change, the 10-year rate of change of that ratio plummets. Once that 10-year rate of change ratio starts moving up, then paradigm shift, you go back into growth stocks. Look at that beautiful bull run, blow off top. What happens to the rate of change? Huge breakdown, rising trend line, horizontal, this wall here, previous resistance, turn support, broke down, flag, breakdown. And guess what this was, guys? This was the bull era for gold, silver, oil, platinum, uranium, commodities, guys. What happens here? It bottoms out to levels pretty much that we had back here. Everybody thinks it's the end of the world. You hear all these fundamental news: Greece default, Italy default, Arab Spring, whatever. All this stuff that you try to trade off, but it's just a minefield. Don't do that. Just look at this chart. All that information is encompassed in this chart only. And it rises here. Here, new bull era, beautiful pattern here. Break above the zero line, 10-year rate of change goes bonkers, blow off top in US equities. And what happened now, while the price is doing a higher high, US equities, look, the 10-year rate of change, lower low. Lower high. Sorry, I'm dyslexic, so I mix that up. Breaking down, bear flagging, just like here in 2001. And this longer term trend line, if it breaks down, guys, bad news for US equities, because that rate of change is bringing it in bear market territory. And here you have an early, almost very almost flat breakdown line. If that breaks down, it's like back in 2001, guys. It's just terrible. So keep this chart in mind. I'll show you the next one. I have many other ones, but I'll show you one more. It's with gold. Gold, silver. Here I have gold, crude oil, but I'll show you with silver, guys. So why is this important? Open a new tab. Here's gold versus money supply. So I'm doing the opposite. I want to see, okay, fine. SPX is underperforming money supply. Okay, I don't want to be in SPX. What should I be in? Well, let's do gold versus money supply. That's the black line, guys. And overlaid here, the orange line is silver. Gold breaking out, moving up versus M2. Here's a 10-year rate of change like I showed you, exploding upwards, resetting above zero, exploding upwards. Gold outperforming M2 is telling you that gold, well, we know the gold chart looks pretty much like that, but look, silver tracks it. You know that silver is doing great gains. So instead of moving sideways like the SPX moves sideways when SPX breaks down versus M2. Well, when gold breaks out versus M2, silver goes bonkers, gold goes bonkers, oil goes bonkers. You see the difference? Look at that. Look at silver appreciate as gold is in an uptrend versus money supply. Here, 10-year of change goes up, up, up. This is fuel, guys. Here, huge bear market. Look at that. It's starting to wake up. A valid trend line. 1, 2, 3, 4. So it's starting to wake up. Pushing the zero line. And this is fuel. You already see here it's an early breakout line done for the gold versus M2. Could have a back test. Going to be some less and less steep angles. So they'll have to go through that. It's not a straight line. If you want a straight line move, go to the yearly chart. On the monthly chart, you'll have a zigzag up, right? And that's how you track the big picture, guys. That's how you know that you do chart-defined macroeconomics. When those huge asset classes, those ratio charts, create great signals that you see every 10, 15, 20 years that newbies never saw before, those give you the signals to know what type of asset class to look at, guys. And this is critical. So you got to be really, really careful. Forget all those headline news. I know people want to always attach a narrative. Well, look at the chart and then attach whatever narrative you want to that chart. The chart I'm showing you right here on the screen, attach a narrative to it. It's manipulation, it's this, it's that. Fine. But respect that chart. First and foremost, respect that chart. Because if that trend, you're trying to fight against it, trying to short it, as the 10-year rate of change for gold is going up, creeping up versus M2, and you're trying to short gold, short silver, short platinum, you're not putting the probabilities on your side. You're just going against the grain. You don't want to do that, guys. All right. That's it, man. Want to keep it short. Thanks for watching. Ciao, guys.